I think pullback trading is the cleanest place for a beginner to start, but only if you understand what it is and what it is not. A pullback is simply a temporary move against the main trend. In an uptrend, price dips back instead of running straight up. In a downtrend, price bounces higher before falling again. The idea is not to predict a reversal. The idea is to join an existing move after the market briefly pauses or retraces. That matters because most beginners do the opposite. They chase strength after a big candle, or they buy because price looks cheap without asking whether the larger trend is still intact. Pullback trading gives you a more practical entry. You wait for the market to come to you. In simple terms, you are trying to buy a dip in an uptrend, or sell a rally in a downtrend, but only when the broader structure still supports the trade. That is the whole concept. It is not magic. It is patience plus trend alignment. The mechanics are straightforward. First, I want to see a clear trend, not random noise. Then I want a retracement that is modest, not a full breakdown. Traders often use moving averages, prior support and resistance, trend lines, or Fibonacci levels to mark where a pullback might stall. Those tools are not predictions. They are reference points. They help me ask a better question. Is price simply breathing, or is the trend actually failing? If the pullback holds and buyers or sellers step back in, that is the setup. The biggest mistake is confusing a pullback with a trend change. A healthy pullback usually stays within the structure of the trend. A bad one keeps cutting through support, making lower lows in an uptrend or higher highs in a downtrend. Another common error is entering too early, before the market shows any sign of stabilizing. Beginners often see a red candle and assume it is a bargain. That is not a strategy. That is hope. I want evidence that the move is slowing, such as smaller candles, a failed push through support, or a clear reaction at a known level. Risk control is where this strategy either becomes useful or becomes expensive. A pullback trade should have a logical invalidation point. If I buy a dip, I need to know where the trend idea is wrong, usually below the pullback low or below a key support area. If price breaks that level cleanly, I do not argue with it. The stop is not there to be clever. It is there to keep one bad idea from becoming a large loss. This is also why pullback trading works better when the entry is near a defined level, because the risk can be measured before the trade starts. In my view, pullback trading tends to work best in markets that trend cleanly and move with enough liquidity to avoid wild spikes. It tends to fail in choppy ranges, news-driven whipsaws, and late-stage trends that are already stretched. If the market is flat, a pullback is often just another random swing. If the trend is exhausted, the dip you buy may be the start of a larger reversal. So the real skill is not finding every pullback. It is filtering for the few that happen inside a trend with enough structure to justify the risk. That is why I call it the one setup many traders should learn first. Simple, repeatable, and brutally honest about when it stops working.